Passive Pockets is presented by Equity Trust. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show. We're your hosts, Jim Pfeiffer and Paul Shannon.
In today's episode, we're shining a spotlight on multi-asset class investments and asset conversion, a strategy that turns underutilized properties into something brand new, from office buildings or motels into multifamily apartments, or big box stores into self-storage facilities.
Joining us today is Clint Harris from Nomad Capital. He's a seasoned operator who specializes in self-storage conversions. He'll share how he got into these unique projects, what market conditions make them an attractive play, and the core principles every investor should know before jumping in. Let's get to it. Clint, we appreciate you being with us today. The topic today, of course, is going to be asset class conversions, and we'll dig into that. But first, can you tell us a little bit about yourself, how you arrived at becoming someone who's converting properties into self-storage, and how you became interested in asset class conversions itself?
Happy to be here. Thank you for the invite. So my name's Clint Harris. I'm 42 years old, married, 2 little boys, live in Carolina Beach, North Carolina. I had a 16-year career in medical sales, working in cardiology, implanting devices. That's a hard way to get ahead in the long run. And so I started an aggressive pursuit of investing in real estate to create an off-ramp from that. I went through a journey of getting burned out with tenants through single family properties and then small multifamily and Airbnb properties. And eventually through that burnout, found my way to self-storage, specifically focusing on self-storage conversion projects where we buy old vacant big box retail buildings like Kmarts, grocery stores, and warehouses. We convert those to climate controlled self-storage facilities.
Very nice, Clint. Excited for you to be here today. I'm really curious about the asset class and just the strategy in general. What market conditions or trends are making conversions an appealing investment thesis right now? And is it higher vacancy, certain property types, shifting demands from consumers, interest rates, or is it something else?
Paul, this is a great question, man. We jumped right into it here. I know we have a lot of other things to talk about besides storage, but the biggest thing from an educational background that I can bring right now is that the consumer in this space has changed a lot. When we traditionally think about storage, we think about low-slung metal buildings, non-climate controlled, baby boomers, Christmas decorations, and heirlooms. The reality is we've seen a massive shift recently. The millennial population is now the largest population segment in the country. They're 34% of the population. They're using 38% of storage. The number one reason for that is that the younger population, unfortunately, tragically, is not able to buy houses the way the previous generation did. They're renting. When you rent based upon the square footage that you're getting. So a lot of times what we're seeing is a younger generation, instead of renting a 2-bedroom condo for $1,800 a month, they're going to rent a 1-bedroom for $1,300 a month. And then they're going to use a climate controlled self-storage facility as an extension of the closet or garage. So that consumer that used to be in the property twice a year is now in the property more than 3.5 times a month. And they need several things. It needs to be safe, secure, well-lit, easy access, and climate controlled, because they're not dropping heirlooms. They're showing up at 6 a.m. on a Saturday morning to get their snowboard and their bibs and to get out of town, or grab their fishing rod or their mountain bike or their road bike. These are lifestyle items. They're in and out a lot more. The point is the consumer has changed. Because of that, the asset has changed. And that's why it makes something like taking an old vacant big box retail building that has great residential density and converting it to a storage facility. People used to go to Kmart to get their home goods. Well, Amazon and Walmart wiped out that space, but it still is a great location for the people in that community to still drive back to the same building.
So when you're talking about residential density, so you're meaning that because they put that shopping building, the Kmart or whatever, in a place that's convenient to shoppers, it's also convenient to these people that are going more often into and we're talking self-storage, we're going to get to the other stuff, but people are spending more time going there, so it has to be in a place that's centrally located. So can you talk a little bit about, is it just the millennials that are using it this way, or other, because you said 38% of the use, so what are the other people, how are they using it? Are they using it in a traditional fashion, and does that matter for the conversion product?
Yeah, that's a great question. And in fact, you hinted at something there that I think is probably a bigger, more important conversation as to how the changes that we're seeing in across commercial real estate are creating opportunity for different asset class conversions, right? It's not pigeonholed to storage, and it's certainly not pigeonholed to Nomad and what we do. But as we're seeing changes across the consumer landscape, it creates opportunity to take old assets and convert them into new things that are going to meet the current demand. So there's time for us to get into that. The biggest thing that we're seeing within storage is yeah, the residential density is what's the number of people in a 1, 3, 5, and 7 mile radius. You're not driving 15 miles across town to find a unit that's $20 cheaper per month. It's all about you go to the places you see, that you drive by, that have a lot of people living around them and that you have access to, right? So take an old Kmart, huge employer for that community, great residential density in a 1, 3, 5, and 7 mile radius, usually one of the major intersections in town, great traffic from the road. In the reality, the land underneath the building is probably worth more than the building that's been sitting empty for 12 years that's on the property. We want to convert that to a different asset class that's going to be used by that population. We mentioned millennials using 38% of the storage, but the other thing that we're seeing is miniature drop shipping locations, hyper proximity in terms of Amazon drop shipping and things like that. So many businesses in the last few years have shuttered. They're just working out of climate controlled storage facilities as a centralized location where they can pop in and out and get product and move it around. And then you have people, obviously during COVID, people were downsizing, moving furniture because they had to create an office in their household as more people were location independent. But the biggest thing is housing is effectively frozen right now. The interest rates shot up higher and faster than they have been. So you have people that can't afford with a 6.5%, 7% interest rate to go find a place that they can buy. They're going to rent. And even the cost of renting has gotten really expensive here. And so for a lot of people, the option is to rent a smaller space and to use that storage as an option to create space for those lifestyle items that they're looking to store.
And you mentioned that there's other conversions, and we're going to try to focus on just conversion generally. Now, you're an expert in self-storage, so of course we're going to turn to that a lot. But some of the other asset types that we'd like to talk about, you can convert office to multifamily. That's been a huge challenge, right? That's a tough one. There's motel to apartment, big box retail to self-storage. And you mentioned one also, mobile home parks converting to tiny homes. So can you talk about the different asset classes that can be converted and why some are better, easier than others?
I'm happy to talk about that. And I think it's important we talk about why we're talking about it. And the question is like, yes, when it comes to real estate, if you work hard enough and you spend enough money, you can probably convert just about anything into anything else, right? But why? Like, why are we doing this? What's the point? And just as a brief example, the point for us of converting like that old Kmart is because it's going to cost us $120 a square foot to build that building, plus the cost of the land. And it's going to take 3 years to go through the entitlement, permitting, and engineering. I can buy an old Kmart. In the last 3 years, we've done about a dozen projects, Kmarts and textile mills and warehouses and all kinds of stuff, that on the day we're opening the doors as a facility, all in for the building that's been empty for 12 years that nobody wants, it's sitting vacant, for the cost of the building, the land, and the conversion, it's about half the cost of ground up development. And it's in about a third of the time. The first Kmart that we bought the building for 1.5 million, 87,000 square feet. It would have cost us 6.5 just to build the structure, right? We still had to convert it and spend money from there. But that's the point of why are you doing this? It has to be one of two reasons. You're either getting into that structure as a finalized project significantly lower than developing it from the ground up, or you have the opportunity to maximize the forced appreciation by increasing the net operating income by switching it to a different asset class. So what are some of the asset classes that people are having success with that conversion strategy? They're obviously office has taken it on the chin the last couple of years. So that's the low-hanging fruit, right? You talk about office space being converted to multifamily. We've all seen it. It's all happening. Let me say this about conversions. Just the projects that we do converting old buildings, sometimes we pick up properties from other groups that tried to pull it off. The reason it works for us is we're fully vertically integrated in-house and we do our own construction. But these are very complicated projects. And the road to conversion success is littered with the bones of people that thought they could pull it off. If you're going to go pay retail costs for a building and you're paying retail costs for the third-party construction and then retail costs for the third-party management, you are likely going to be eaten alive and the juice is not worth the squeeze. For the people that have the pieces in place to pull it off, you can take an office building and you can convert it to a multifamily apartment complex. But now you're talking about, say it's 100 units. That's 100 kitchens, probably 200 bathrooms, water, plumbing, electrical, sprinkler systems, everything else. The building was not built for that intended use, right? You're converting it. It's called adaptive reuse. That's the challenge. The beautiful part is you're not buying it as a multifamily property. You're buying it as whatever that shell was, and it's worth basically whatever you're willing to pay for it.
So you're buying a distressed asset, right?
Yeah, it's just like, you don't make your money on a house that you flip when you sell it or renovate it. You made your money when you bought it for dirt cheap because it smelled like dogs and cats. We want the ugly ducklings that we can turn into golden geese, right? So you're buying it at the valuation of whatever this square footage is on this distressed property that's likely been sitting there for years. When you change the asset class, you change the formula by which the asset is valued. So it goes from a price per square foot to a net operating income approach divided by the going cap rate in the market. An average self-storage conversion in the Southeast, you can buy a building for $2 million. You can put $2 to $4 million into it, be into the whole project for $4 to $6 million. And if you're doing it right and you choose the right market, it's going to appraise in the $12 to $17 million range as a stabilized asset. It takes some time and some skill, but that's the value versus that same project. You would be into it for more than twice that amount for ground up development, and it would take about 3 times as long. Here's the challenge. Only about 70% of office buildings will even convert to self-storage. Office buildings are built with about 75 pounds of pressure per square foot. That's what they're rated for. Storage needs double that. It's got to be forklift rated. We have to get the same certificate of occupancy that people get for multifamily. So it's easy to make a blanket statement like, oh, we're going to go convert all these buildings to multifamily. Sometimes the challenge is not just putting in the kitchens and the bathrooms. Sometimes the challenge is the structural engineering that even makes it possible.
And what do you mean by that? Does that mean like you have to do a lot of reinforcing kind of things to make sure that, the office can hold a kitchen?
Yeah, if it can even be done. You might affect the structural integrity, getting the plumbing and sprinklers and electrical in place to the point that it's not going to make sense to do it. It would be cheaper to build it from the ground up. But for the people that know how to find the right deals, office converted to multifamily is still very popular right now. Hotels converted to multifamily is probably a little bit of an easier lift because they're built for residents. Now they're smaller, so a lot of times those are converting to 1-bedroom condos, or maybe you're blowing out a wall, but even when you double the space, you reduce the number of overall units. But hotels being converted to condos or multifamily is very popular. We obviously do storage conversions from big box retail. I've got a friend of mine locally who just bought his 3rd RV park. This is what you and I were talking about prior to recording. He's a tiny home manufacturer. And so he started buying RV parks and over time, moving people out and converting those to tiny home villages with Starlink internet and podcast studios and amenities for people that are basically location independent. You got these people that are looking to reduce their housing expense that have become location independent. They can move out of the city. They can buy a tiny home for $60,000 to $90,000, depending on the size. And then they're just paying lot rent. And he's got the most stable mobile home park in history.
They're living in an RV park, but in a tiny home. So you're almost camping and living there at the same time?
Correct. But these tiny homes these days are granite countertops, stainless steel, LVP flooring. I mean, they even make 2-bedroom units now that are 40 feet long. So it's an example of what is an old defunct RV park worth, or a mobile home park example for sure. Like you can take this from the traditional, what you think about a mobile home park and the clientele. And these are good, hardworking, honest people. Some are managed better than others. And usually the tenants are a reflection of that. But you can convert that to a different asset class that's a permanent neighborhood with people that own the properties. In this situation, he's selling them the tiny home. So he's making money there. And then he's building these really established communities of people that he's hand picking. And when you convert it to a different asset class, it changes the valuation on the dirt.
What's the difference between a mobile home and a tiny home, right? Because mobile homes don't move anymore. So is there a difference?
The optionality, the consumer, and the finishes that are coming with it. A lot of times the mobile home is like the cheapest option they can put together. And what they found is that within the tiny home space, people still want really nice things. And you can get that. And this is brand new Class A construction that you can haul in or sometimes crane in. Usually they're built on a chassis, on a trailer, but it's specifically garnered towards people that want to live there for a few years, but if they decide to get up and move, they can do that. Traditionally, a mobile home, like once it's there, the next time it's moving, somebody's hauling it away and it's going to the dump or something like that. So it's listening to the marketplace, the consumers. He had a buyer's list of 80 people that were like, I'd love to buy one, but I don't have a place to put it. So he was solving his own problem by finding that, which appealed to me because I specialize in asset class conversions, right? Adaptive reuse. And it always comes down to what's the valuation on which you are purchasing this commercial asset? What are you converting it into? And how is that conversion going to change the formula by which that asset is valued? Hopefully in a way that creates massive forced appreciation that you can recapitalize through a refinance or whatever it may be.
I've heard that described as cap rate arbitrage in the past, Clint. I think it's such a cool concept. I recently reviewed a deal in Houston where an operator was buying a hotel that was distressed. And in Houston, from what I gather, the going cap rate for properties and where they're trading at is about 8%. And by converting it to multifamily, the cap rate for multifamily is about 6%. So that arbitrage, there's immediate value created just by rezoning it in that market. You don't have to rezone at all. So they're going to grow the income. They're going to fill some of the gaps that are needed to convert it to multifamily and immediately have a value that is much greater than it would be if it had the same income as a hotel. So I think that strategy is really awesome. Let's talk about what makes a conversion opportunity valid or invalid from a property characteristic standpoint. Is it specific to layout of the property, zoning? Is it location? I know obviously you're in self-storage and you've worked with some big boxes, so you can be specific here on your experience. What is it that really excludes a property from being a candidate to convert versus, oh yeah, this is a home run, let's do this?
First of all, let's all admit here, I know a whole lot about very, very little, right? I am pigeonholed and I do one thing. And I think our team does an incredible job of doing it very well. And I'm blessed to be a small part of that team, but that's what we do, right? Outside of that, with the broader conversation, obviously price is paramount, but the unique thing is exactly what you just brought up is you can negotiate a decent price based upon what it is, but you're not going to tell them what it's going to be, right? And even if they know, like you're the one doing the heavy lift, if anybody could do it, they probably already would have. So you negotiate a deal based upon what is the valuation on the property as to what it is. And then you can do the math as what's it going to be as a stabilized asset class. So for me, specifically looking at storage, and let's be honest, like each adaptive reuse or cap rate arbitrage, and I love that term, is going to have its own KPIs, right? Its own things that it has to hit. For us, I need things like 10,000 people in a 1 mile radius and 25,000 in a 3 mile. I need a ton of vehicle traffic count. I need great visibility. And my biggest concern is the only thing I can't control is how much other storage is in the market. I'm going to look at all the permits and see how much other storage is coming. And then what's the residential density and is the population rising or falling? What's the percentage of people in that area that are renting versus owning? Because renters traditionally use more storage than not. So all those things come into play. I'll put it to you this way. We have an acquisition team in-house here that's looking at 50 to 70 properties a week to get down to 1 to 3 a month that we send a letter of intent on. It's laborious, and the lion's share of the properties that we find don't work. And that's just the nature of the beast. And we've gotten pretty good at this. Even then, out of that 50 to 70, we hope to find a couple that are going to pan out. So for us, we don't have kitchens, we don't have bathrooms, we don't have tenants. I am renting somebody a box of air. But what we need is a lot of people, and those people don't want to drive far for their storage. And I can give them a great price because we're half the cost of any other storage around there. But I want to move into a market that is underserved with an existing need for storage. And this is another thing that we haven't brought up yet with a lot of adaptive reuse. My model is I want to move into that market, secondary and tertiary markets across the Southeast. And I'm going to go find the old textile mill right in the middle of downtown. And I'm going to get that converted to storage in 12 months. If anybody else wants to come into that market, they're going to have to find 5 to 7 acres. It's going to be really hard to do that close to the middle of downtown that's got all the new multifamily projects popping up from people being pushed out of the urban areas into these more suburban markets. And even if they do, it's going to take them 2.5, 3 years. The time component of the asset class conversion is really important. What's your carrying cost? If you're going to go build a multifamily apartment complex from the ground up, what's the timeline on that? Versus if you go buy the old cotton mill downtown, which is first of all super cool and a great location, and you can get a great deal on it, and you convert that, even if it costs the same amount, but it's 2 years faster, that alone pencils for a lot of people, right? So there's a time component, there's a cost of construction component, and then there's like, what are the KPIs for that individual asset class that makes sense? And then obviously paramount is what's the price per square foot of what you're getting it for? And luckily, If it's a distressed asset, you're usually the one determining what it's worth. It's worth what someone's willing to pay for it.
So you mentioned time. Are these properties typically vacant when you acquire them? And then also related to time, are you closing on the property with entitlements in hand, or is there still uncertainty from that front after you close?
The other thing that you mentioned earlier leads right into that, the entitlements on the property, and that's the permitting, right? The permitting and the zoning is something that I kind of glossed over there. That's something that we do really early on in the process. Can this be converted to storage in our situation or whatever it may be? Like, that's paramount, and every town or area is going to be a little bit different. So those personal relationships and digging into that, it's something that we're just doing in our due diligence leading up to signed purchase and sales agreement or before money goes hard. So that's really, really important there. And you got to dig into that and know what you're getting into. And then you kind of take it from there.
Is it usually where you're buying something that you said might have been empty for 10 or 12 years, because these are assets that no one wants anymore? They're not optimized. So do the cities or whoever has all the zoning requirements, is it usually easier to get that through than if I'm doing brand new development where I have to get all the entitlements? It seems to me that this would be a little bit easier because they're like, ooh, eyesore. There's an old Motel 6 on, Route 33. Let's get rid of that and put apartments there. Same with self-storage. Does that help at all?
Yeah, the older and nastier the building for us, first of all, the lower the price, the less competition. And third, more likely that town or area is going to be really excited about someone finally doing something with the old boot factory, which is one we're converting right now. We got a boot factory and a carpet factory going right now that have been empty for years. In terms of the question of vacancy, when they are vacant, it's typically easier to get them because they've been empty for a long, long time. Like, we want the ones with the hole in the roof and the homeless people live inside and the rats the size of possums kind of stuff. But at the same time, we pick up properties that are sometimes, these are huge properties, right? 90, 100,000 square feet sometimes. So we picked up one in Kernersville, North Carolina recently that was a 90,000 square foot building that had a 15,000 square foot antique mall that's currently operating, and they're paying $10,000 a month. We bought another one that is a giant warehouse attached to a brewery. It was a purchase lease back. We purchased the whole thing. We leased the brewery back to the brewers there, which are the ones that sold us the warehouse. We've converted it to storage, and they're paying $15,000 a month for 10 years, right? So sometimes there's a combination. We have one that came with 2 houses on the back of the property. They're complicated, right? Anytime you're getting into a conversion, it's a hairy deal, right? There's always things on there that allowed it to go this long without somebody doing something with it. You've got to have a strategic plan as to what you're going to do. You have to have the chops to pull it off, and you have to be able to control the risk, usually by being the contractors and doing the building yourself. So every project is a little bit different. And if it costs a little bit more because there is a cash flowing component on the property, it's okay to pay a little bit more if that means you have to raise a little bit less capital because your interest reserves aren't quite as high because you're making 10 grand a month from this piece of the property over here, right? And maybe that's something that 2 or 3 years down the road, after the rest of the facility is stabilized, there's an extra 15,000 square feet you can convert to storage if you needed to down the road, something like that. But the more complicated it is, at first it's daunting. Once you start doing conversions and you're working in that space, you walk into an old property that stinks. It smells like money, right? That's opportunity. That's off-putting for someone else. And if it's off-putting for them, then it likely means we can get a better cost basis on it. And then we're going to convert it to a different asset class, and it's going to change the valuation.
Well, so you're talking about these big, hairy, ugly properties, right? You're walking into and you're smelling money and you're loving it. And then you go to the bank and the lender and they're smelling something different.
Yeah. What an eloquent way of putting that.
Yeah. Thank you. And how do you get financing for something like this?
Typically, we're buying these buildings for about $1 million to $2 million less than the appraised value and significantly below the replacement value. So on average, 1 to 2 million below what it's actually worth, right? It's just that nobody wants 100,000 square feet of big box retail space.
Right. Or a boot factory. I mean, what's the replacement value of a boot factory when no one wants to, manufacture boots anymore? I mean, how does the bank or a lender get their hands around that?
First of all, the bank is going to look at it and you're exactly right. Like, nobody's making boots there. Nobody's making carpet over here. Like, they're looking at it. And a lot of times that commercial listing, or a lot of times they're off market, it's going to be brought to us and they're going to give us a quote for tearing the building down. We're like, no, don't do that. The bank is looking at it. They're looking at our track record and what we've done, and they understand what we're converting it into, which is obviously a huge risk. But the fact that we have usually $1 to $2 million worth of equity on the property from day one, that helps. I can't speak to all different operators. Storage is a little bit different because these buildings are, in the grand scheme of syndication, these are very low purchase prices and very low capital raises. That having been said, a lot of times they're looking at the building and what we're doing, and they're giving us fixed rate debt, typically around 65% loan to value right now. We've never used variable rate debt, always fixed rate, and we've never had a problem getting that so far. A couple years ago, we were getting 75-80% loan to value with a 3.25% interest rate. The last year and a half, we're looking at around, I think 6.85 to 7.25 is the interest rate we've been getting recently. Always fixed rate, 25-year amortization, 5 to 7 year balloon, and at least 2 years of interest only payments, sometimes 3. They're basically looking at, it's a whole pitch, right? What have you done in the past? Here's the building. You're paying $2 million for it, but it's worth 3.9. That certainly helps. We know what you've done in the past and what you're going to convert it into, and they're going to give us a relatively short term. The good news is what the bank is really worried about is getting the certificate of occupancy. We have a project in Kernersville, North Carolina. We're all in on the project for $5.5 million. Exactly what I told you about. It's a 90,000 square foot facility with the 15,000 square foot antique mall along with it. The construction on that property is going to be done in about 4.5 to 5 months. And the bank appraisal puts a valuation at the property on certificate of occupancy of $11.3 million. And at stabilization, they put a valuation on of $13.4. So at certificate of occupancy, we still have to make the payments, but the bank feels very secure that if we don't and we have to toss them the keys and walk away, they're going to be just fine, right? So it comes down to, let me say this, to anybody listening that's not doing conversions, that's thinking about investing in one. I don't care what the asset class is, multifamily, RV parks, doesn't matter. The most important thing is who you're partnering with and the operator's ability to execute the business plan. That's the number one thing. And that's what the bank cares about, right? And so for us, we're fairly low leverage. We're never going to over leverage. Our job is to protect the asset first, the investor second, and ourselves third. In that order, I recommend partnering with anyone else that feels the same way. And the bank is obviously, they want to make sure that we can pull it off. The way that we reduce the risk on the property is by not having variable rate debt. That initial purchase price and having day one equity of $1 to $2 million definitely gives the bank the warm and fuzzies a little bit, but then they're looking at track record and our ability to pull it off.
Clint, besides just the population in the area, what other metrics are you looking at? Drivability, how close, people are to the asset? Are you doing feasibility studies? Is the lender doing feasibility studies? I guess, are you evaluating the competition in the area to see, hey, there's all the storage units are absorbed here. Obviously there's a need for more, or hey, there's a lot of vacancy here. If we put up this new one or we convert this building, is there going to be demand for it? How do you evaluate that?
The number one question that I would say that we have about an area is actually not the price on the building and it's not the zoning. It's how much storage is in the area, how full are they, and what's the net rentable price per square foot. If you got 100,000 square feet, about 70% of that is going to convert to storage. So if we got 70,000 net rentable square feet of storage here, what's the average price per square foot that we're going to be making over a year? And that's going to be a reflection of the market. For instance, like we're across the Southeast, North South Carolina, Tennessee, Virginia, Georgia. In the state of South Carolina, which is my home state, by the way, it's very, very splotchy. And you have areas in there that are $18 to $22 a square foot. You have other areas that are $12 to $14 a square foot. And if there's competition in that area and that's just what people are used to paying and nobody's really ever pushed the boundaries there, or if there's an oversupply, it's really going to be hard to step into that market. One insight that I'll give you that I've found to be very interesting over the last year or so, looking at Radius Plus and a few other different data sources, self-storage developers used to be really scared to go into a market that had an oversupply. And it used to be, they would call that 8 square feet per capita type of a deal. That's not the concern anymore. Instead of how many feet of storage is there per person, the question is, what's the price per square foot? If there's a ton of storage in the area, but it's all full and there's a waiting list at every facility and it's renting out at $22 to $24 a square foot, we're probably going there. If there's opportunity and we find the right property, we're moving in. Then it has to check the boxes of what's the residential density, what's the 135 mile radius, what's the percentage of renters versus owners, the number of cars driving by every day, what's the visibility, all those things. But paramount is really like, okay, let's fast forward in our minds 3-4 years from now. What does this property performance look like? That's typically a reflection of the other properties in that market. Obviously, that's more geared towards storage. And again, I think I'm maybe pigeonholing myself a little bit talking about storage. across the asset class conversion landscape, that's going to look different. But basically, if you're looking to build out an old mill into a multifamily apartment complex or something like that, you want to look around at the area and see what are they renting for? What are the amenities? How are we going to be competitive in that space? And then you want to zoom out from there and you say, okay, is this population rising or falling, right? What large production facilities are coming to the area, or what's this state doing to drive business? Or do we have a giant battery plant coming in 7 miles away? Anything that you can do to try to get an idea of what that future demand is going to be. And then you're using that to pick the right spot. And then your key is to try to get in at a lower cost basis than your competition who's building from the ground up, because they only have so low that they can go on their price per square to break even. We've never had to play the price game because we're moving into areas that are underserved, but we could if we needed to, because we're half the cost of ground up development. So if you can get over that initial hurdle of getting it done, it does give you some grace in terms of the operations and the management.
You've talked about, you got to find an operator who can execute on the business plan and an operator who has a track record. So can you talk about generally with these conversions, why do these projects fail? And as a limited partner investor, how do I analyze a deal and say, yep, this is one I want to take a shot at?
On a larger development project, a lot of times the carrying cost is going to be what potentially it's a risk, right? It could eat you alive if you let it. Our average deal takes about 10 to 12 months to do the conversion. If we're using a third party contractor, especially one that hadn't done this before, you're probably looking at 20 to 24 months. The biggest thing with any kind of development is the change order. Anytime you have any kind of change order, the GC is changing things for the subs and timelines are shifting, and any kind of change order can push things back 1 to 4 months. And then you have 4, 5, 6 of those on a property that's millions of dollars. Your carrying costs creates a lot of risk when all of a sudden a project that was supposed to be 20 months is 36 months. That's just to get to the point of getting a certificate of occupancy where you can open the doors to start renting units, right? And all of a sudden that conversion may have been break even at 40% occupancy. Now, because of the incurred risk and the cost, the break even may be 65% occupancy, which is going to take you another year and a half on the back end. So that's more carrying costs that you have to add on. So the biggest thing is the development and understanding that you have to be able to roll with the punches, because what I just said was, if there is a change order, it can potentially add to your timeline and create a lot of risk down the road. The second comment I have to say is this: there will always be change orders with a conversion. You are signing up to go into battle with your partner, and there's going to be challenges because whatever that is that you're working on was not built to be what you are turning it into. That goes for any asset class that you're converting, right? If it is going to turn into something different than what it was originally designed for, you're going to run into challenges there. And so the best way, in my opinion, to control that risk is to work with someone that this is all that they do. They have a track record of doing it and that they can be on the ball. If something happens, for instance, recently there was a strike at the ports. The next day I was in my office, I was talking to our project manager and I was like, hey, I'm going to get questions about this. What's going to happen? And the answer was, I just got off the phone with our supplier for our doors and our panels. They have enough material right now for our next 3 jobs. I also know who's supplying them the rolls of metal to make the doors. We've called them. They have enough to do several more projects after that. And beyond that, we've called different suppliers that can continue to get that metal for us if we need to, that's coming through the West Coast port, because we know that the East and the Gulf ports are closing down right now. And we need to go ahead and factor in a 15% increased cost of materials that are going to eventually go to the door and the panel company. And we know that cost is going to get rolled down to us. So we need to be thinking about factoring that in and padding our stats with that. That's not something you're going to get if you just are using a third-party contractor to come in and build it out. That vertical integration is the best way to control the risk. And if I was going to go, and I have invested into multifamily and other conversion projects, I want to see their structure from top to bottom in the organization. I want to see their pro formas. I want to see their timelines. I want to see if they're hitting them. And I want to see where they're controlling the equation, because wherever they're not controlling the equation, it has potential to increase the timeline, and increased timeline on a project this size really has potential to throw off the returns. The vertical integration from top to bottom is probably the best way for the limited partners to look at an operator and control risk as much as they can.
So, Clint, I'm going to ask you to get out your crystal ball here for a bit and predict the next 5 years. There's always some headwinds, and there's always some tailwinds. It kind of teeters back and forth. We're in a cyclical space. So talk to us a little bit about how you feel the conversion strategy will play out over the next 5 years. Is it still going to be relevant? Is it going to be more relevant? And what are some of the potential tailwinds that we could face here?
I think across the conversion space, it's going to get picked over. Potential projects are not going to stop hitting the market. We have ups and downs in the cycle. More projects are going to show up, and we can look in the same market right now, and from year to year and month to month, different deals are going to pop up. A lot of the ones that are bigger have been sitting on the market, I think it's likely that a lot of those will get picked over. I think within our space, I feel great about storage because it's certainly not going away with the millennial changes. And the biggest thing about storage is when you open up a new facility, you got about a 30% expense ratio. You're doing promotions and buy 1 month, get one the second month for $1, whatever it may be. Once you stabilize and you fill that expense ratio typically drops down to the 21 to 24%. And it's extremely inflation resistant that you can increase the rents month over month. The only commercial asset that's more inflation resistant is hotels that can literally change their rates on a night to night basis. So I think we're a little bit insulated in the storage space, with the exception of the only thing I can't control is how much other storage is in the market. So there's always potential for oversupply, which is why we avoid primary markets. Across the board, I think that you're going to see some disparity, and there's going to be a socioeconomic divide between the people that are able to pull off large conversions and do it really well and the people that dabble and try. This is one of those things that, to me, it feels like there's a lot of people moving in this space looking to do a conversion because it's the cool thing to talk about. But the reality is this is not something that you dabble in. You either do this or you don't do it. And so I would hesitate to say that most of the people that have been doing ground up development or whatever and decide to do a one-off conversion, there's a very good chance that they get away from that and go back to doing traditional development. The people that are doing conversions and doing it really well are probably going to be the ones that continue to have success. There's probably going to be a few names that kind of rise to the top in terms of raising capital from investors, but we all know enough to know that we don't know everything and that things are constantly changing. There used to be a pharmacy on every corner, an Eckerd's, a Walgreens, whatever, CVS. They're shuttering left and right. And I think things like Mark Cuban's pharmacy company or Amazon Pharmacy is likely to wipe that space out. And so what are all these properties in that location? What are you going to do? You're going to put in 2,500 pickleball courts across the country? Something's going to happen. The key is the fact that people are now looking. The first person to figure out was conversion was somebody way smarter than I am, right? But now that my eyes have been open to that, every time I look at a commercial asset that seems like a good deal, I'm like, ooh, what could we turn that into? And now that you've opened that Pandora's box, I think there's going to be a lot more people looking in that space. And I welcome the creativity. The world is changing fast, really fast. And consumers are changing. There's generational differences. That's not going to stop. And so I think as long as that continues and the consumer is changing, there's a delta there, right? It was whatever it is was built as this. The use was that over time, the consumer's doing this. For those that are listening on a podcast, maybe that wasn't the greatest example to use, but there's a delta, there's a gap, right? Widening between the intended use of the property originally and what the consumers are looking for. If that gap gets wide enough, someone is going to find a way to step in and convert that to something different. So I think that it's going to continue. I also think that there is a little bit of false sense of security as to how easy it is to do a conversion across all asset classes. And I think quite a few people are probably going to take it on the chin before people figure out that, it's not for everyone.
This was fantastic learning about asset conversions. We really appreciate you sharing your knowledge with us. And thanks for being on the show.
Thank you so much. Great to see you both again. I appreciate you having me on.
Thanks, Clint.
That's it for today's discussion on Passive Pockets. We want to give a huge thanks to Clint Harris from Nomad Capital for joining us and breaking down the ins and outs of real estate conversions.
Conversions can be a powerful investment strategy, but as Clint pointed out, they require careful due diligence, thorough market analysis, and solid lender relationships.
Bigger Pockets has something really exciting coming up. Momentum 2025. Starting February 11th, join us for an 8-week virtual series every Tuesday from 2 to 3:30 p.m. Eastern Time, where we'll dive into all things real estate to set you up for 2025. We've got 18 amazing guests lined up, and they'll share their insights on what's happening in the market and how to make smart moves in 2025. This isn't just about listening. You'll get to meet other investors in small mastermind groups. It's a great chance to share ideas and get feedback on your own plans. You'll have direct access to seasoned pros who have built impressive portfolios and tons of bonus resources. By joining, you'll get over $1,200 worth of goodies, including books, planners, and discounts for future Bigger Pockets conferences. It is a fantastic package.
If you enjoyed this episode, don't forget to like, subscribe, and share your thoughts or questions in the comments. For more resources on passive investing, visit our website, PassivePockets.com, and join our community with a 7-day free trial. Thanks for tuning in, and as always, happy investing.